Hi. Let's learn about junior debt. Junior debt refers to bonds or other forms of debt that have been issued with a lower priority for repayment than other, more senior debt claims in the case of default. This means that if a company defaults on its debt, the holders of junior debt will only be repaid after all higher-ranking debt has been settled. As a result, junior debt tends to be riskier for investors and thus carries higher interest rates than more senior debt from the same issuer. Junior debt is synonymous with subordinated debt, and it may refer more generally to any second tier of debt paid immediately following the repayment of senior debt. In the corporate debt market, corporations have more flexibility obtaining capital through debt compared to the equity market. A corporation may work with a bank to obtain a loan, work with an underwriter who leads a loan syndicate with multiple investors investing in a loan deal, or issue bonds with varying repayment terms. It is important for fixed-income investors to understand the classification of junior debt when evaluating various bond issuances of a firm. The priority of repayment will generally follow the order of senior debt holders, followed by junior debt holders, preferred shareholders, and finally common stockholders. An important repayment term for all types of credit is their repayment seniority. Loans and bonds can be issued as senior debt or subordinated debt. Senior debt is repaid first if the borrower encounters a default or liquidation. Generally, senior debt requires lower interest payments and bond coupons since it has a lower risk. On the other hand, subordinated debt follows senior debt and has its own repayment terms. Investors are willing to take on the higher risk of lower seniority payments in default by being compensated with higher rates of interest. Generally, junior debt and subordinated debt is unsecured debt that is not backed by collateral. In some situations, corporations may issue junior debt bonds. It can also be common in structured products where investors have the option to invest in varying bond tranches as part of a bond issuance. The junior debt repayment procedures in the case of default will be clearly delineated by the underwriter in the terms disclosing the investment details of a bond investment. Here are 4 key takeaways. 1. Junior debt refers to bonds or other debts that have been issued with lower priority than senior debt. 2. Also known as subordinated debt, junior debt will only be repaid in the event of default or bankruptcy after more senior debts have been first repaid in full. 3. Unlike senior debt, junior debt is not typically backed by any type of collateral. 4. As a result of these attributes, junior debt tends to be riskier and carry higher interest rates than senior debt. Hope this would help. Thanks for watching.